Sounds good. Yeah, we'll dive right in because it can be hard enough to get all this into a span of time we have. So, because it's such a broad concept. So, if we back up for a second, Bitcoin is still characterized as a risk asset by a lot of pools of capital. And so, that might not be the case for some investors that put 1,000 hours into it to understand it at a deep level. But due to its high volatility, it's still very much in the risk on bucket as far as most assets are concerned. And so when we take a step back for a second, we can look at these rate of change of economic growth. And so some of the near-term outlooks for Bitcoin are, somewhat challenging, somewhat uncertain, even as the longer-term outlook, still remains very strong. And I think that, basically as we go forward, as more analysts come into the space, there's more and more coverage of Bitcoin and the broader ecosystem. And I think that's only going to strengthen over time. And so, something I've been kind of warning my clients about recently is that the data comes in and shows that in the United States and much of the other kind of Western countries, we're seeing somewhat of an economic deceleration in 2022 compared to the kind of the sugar high we had in some ways for 2021. And if you look back historically, Bitcoin's major bull runs are actually during these periods of economic acceleration. And so when we look at this chart here, it's the U.S. Purchasing Managers Index, and we see that back during like the period in 2020, the period in 2017, the period in 2013, these major kind of upward inflection points in economic growth were also tied into Bitcoin's bull runs, and that could eventually decouple. We could eventually see a changing of that. That kind of correlation that goes on. But historically, that's been the case both for Bitcoin and other risk assets. And so as we look forward, most of the leading indicators continue to suggest that this is softening. And I think that comes down to not necessarily making decision points for Bitcoin related on that, but it's about managing expectations and about kind of understanding the range of outcomes that could happen. What do you want to hold on your balance sheet, either as an insurance company, as a corporation, as as a hedge fund, as a retail investor? What do you want to have in your balance sheet? Right now, cash is a very expensive form of optionality. It obviously gives us volatility protection. We need it for our working capital. We need it for a variety of different purposes. But it's near the high end of how expensive it is in terms of losing purchasing power over time as you hold it. And so the chart I have here on the left shows federal debt as a percentage of GDP over time. And we see that whenever it gets to very, very high levels, you tend to run in these persistent periods of negative real interest rates for cash equivalents. So that can include cash in the bank, that can include T-bills, basically a variety of these risk-free, low volatility ways of storing value. And that's, if we look at, if we broaden this to other countries, you generally see that's the case. Whenever you have very high debt levels, you start to run into these financial repression scenarios where central banks have a tough time raising interest rates to positive real levels, compared to CPI, let alone compared to the growth of the broad money supply. And so you see many of the high quality assets, going up in value even faster than CPI. And the chart on the right there it shows another way of looking at this. So those green areas are positive real rates, and those red areas are negative real rates. Western central banks kind of find themselves in a tough position right now because on one hand, they've never been further behind the curve in terms of inflation, at least going back to about 1951. So in modern history, they're about the furthest they've ever been behind. But on the other hand, when you have the prior slide showing economic deceleration, they find themselves historically, they tend to raise rates and tighten policy into stronger periods. And so, for example, the last tightening cycle they did, they tightened through 2017 and into 2018. When you're looking at the different options for what kind of assets you can have in your balance sheet, this gives kind of the high level view of why holding cash and cash equivalents is so expensive, at least when you're looking at longer term. And we can look back, in history during prior inflationary episodes in the market, and we see that there are very different types of responses depending on how much debt is in the system. And so when we think of high inflation, we often think of the 1970s. And the chart on the right here shows the Fed's, basically I use 3-month Treasury bills as a proxy for short-term rates here because the data set goes back really far. But essentially what you had here was the Federal Reserve was constantly trying to tighten and raise rates to rein in inflation. And they were able to do that in large part because debt as a percentage of GDP, both in the public debt and private debt, including household debt, corporate debt, all these different types of debt outstanding, they were pretty low, and so they were able to raise rates, and it caused economic weakness, but it didn't necessarily cause like a solvency event. Whereas back in the 1940s, which, as we go back to here, was the last time debt as a percentage of GDP was as high as it is now, you had a pretty big decoupling in terms of inflation and interest rate policy. So I think a lot of macro indicators show that the 2020s are shaping up to be very similar. I mean, we already had this big spike here. We had the largest ever decoupling in terms of inflation and rates since the 1950s, and I think we're going to get probably more cycles of that going forward. And so that's another good kind of backdrop for having Bitcoin as a way to protect against that. It doesn't necessarily hedge you the moment you get different CPI prints, but it's basically a structural way of holding something that has intrinsic scarcity compared to something that is intrinsically not scarce, and that for which the yields are no longer keeping up with inflation. And what I have here is the the 1+ year HODL wave. We could also call it the Bitcoin distribution cycle. And what we see here, so the blue line is Bitcoin price, and the yellow line, the orange line, is the percent of coins that have not moved on chain in more than a year. Bitcoin can be held multiple ways. Some people hold it on chain, some people hold it on exchanges, some people hold securities that are tied to Bitcoin in different ways. And this is looking at the very large snapshot of on chain, which is a very big part of the market still. And what you generally see is that during these major bull runs, all this new capital comes into the space, and some of those longer term holders start to sell into that strength. Basically, they experience 5x, 10x, 20x gains in some cases. They have these, they have these life-changing amounts of capital appreciation. They want to rebalance, they want to consume, and so they distribute into some of that strength, and a lot of that new capital pours in. And then you generally see during these more consolidation type of markets, these bear markets, you generally see the reverse. You have the longer term, more knowledgeable, higher conviction holders go back to, they become a larger and larger share of the market over time. And so what we see now is that we're back in this distribution cycle where, during the early kind of bullish period of 2021 and the whole phase there, those longer duration holders are willing to sell into that new strength. But then throughout this consolidation that we've been in for the better part of a year, those longer term hands have not been willing to sell at these prices. And many of them are still accumulating at these prices, dollar cost averaging. Coins are continuing to go from kind of those faster money hands or those weaker hands into those longer duration, stronger, less liquid hands. And so that's generally what sets up kind of the next cycle. You have the macro events. You have basically, you can separate it into demand and supply. So on demand, you have what we covered before, things like risk on or risk off periods, how much liquidity is in the macro environment. So on demand, you have what we covered before, things like risk on or risk off periods, how much liquidity is in the macro environment. Those types of factors can determine how much capital comes into the space or leaves the space. Meanwhile, the other side of it is the supply side. How much of the existing coin base is available for liquid purchase versus how much is locked up into very strong or illiquid hands. And what's made this cycle rather unique is that, in these prior periods when you had these peaks in demand, that was the top of the cycle. Whereas actually in this time so far, we hit a slight new high later in 2021, not because demand was as high as early 2021, but because you had moderate demand and really, really tight supply. And so there's really two sides of the market to keep monitoring. Basically different analysts, I think, focus maybe too much on just the demand side or just the supply side. And when we put both together, basically what we're seeing is right now we're in kind of a weak period for Bitcoin demand, as you would expect from economic deceleration, liquidity being pulled from the market, while the supply side is one of the most bullish setups we've seen. And so that kind of can segment our expectations about maybe the longer term outlook versus that intermediate term uncertainty. And for the last slide, this is a chart from Yuri and Timmer of Fidelity. I think he's been doing really great coverage of this space. And so he has a demand curve model. Basically, you can model Bitcoin as though it's a network effect, as though it's similar to internet adoption or mobile phone adoption. And so you have this kind of, the monetization of this asset over time, that this asset acquiring a monetary premium. And so you occasionally go, way above the demand curve. You get that you get momentum traders jumping on board. It's not like this it's not this very smooth adoption, but it shows that based on that model, we're towards kind of the value side of that. We're not necessarily in capitulation mode. The last time we had a capitulation was March 2020 during the COVID crash. The prior time was that late 2018 period, which was when the Fed was trying to tighten into declining PMIs, declining economic acceleration. We absolutely could have a lower capitulation, but I would say that we're already kind of in what has historically at least been a valuation. And you can look at all sorts of indicators like dormancy. It's basically another way of measuring are long-term holders selling their coins or not. And most indicators keep showing the supply side remains very tight. And so I think we're in this. I think we have to manage our expectations maybe about the next 12 to 18 months. Understand that Bitcoin is treated as a risk-on asset by many pools of capital, but that the long-term story looks very favorable now, and that if people basically are looking to get into the space, the network just went through a 50% plus correction, and that basically I think that the supply side is still kind of long-term bullish.